Bill Baruch, president of Blue Line Futures, joins us today to talk about the economy and his market outlook. Bill, welcome back. Monday's sell-off seemed to have been completely erased. We're bounced right back. I was hoping to talk to you about market volatility, but there's not much volatility going on today on a Wednesday. Do you feel good about the markets? What's your sentiment like?
Yeah, it's been a directional rebound, and between yesterday, Tuesday, and today. But is it really that surprising? I mean, the S&P, February, I think twice in March. We saw it again in April and May and June. And I mean, the market goes and hits a 50-day moving average. It hits it's building a sort of trend line as well, and it tested it perfectly. And the market bounced up. People were really waiting and expecting that to be a buying opportunity. It's become pretty systematic. I don't think the volatility is done quite yet. From a trading perspective, we were positioning to capture some of this downside move. From an investment side, we still have hedges on going out quite a few months, and the S&P just to hedge some of this exposure. But I think things started to really turn when you saw the reversal of the treasuries, and I wrote about that in my morning note to clients, that you got to keep a very close eye on the treasury market. And if yields continue to rise, the volatility is going to start to show on the tech side, the high multiple tech side. But counterintuitively, it was when yields were falling through the end of last week, Delta variant fears that that actually dragged the market down. So I think we're just in a very sort of fickle area at very elevated levels, and these healthy pullbacks. They're nice, but they're very, very quick. But I think we need a little bit more of a healthy pullback.
Yeah, there were definitely fears about the Delta variant of COVID on Monday. That's all I read, headlines everywhere, except, unlike last year, not a huge impact on the market. So we'll see if anyone actually follows through with shutdowns. What do you think is going to happen? Do you think we'll have another round of shutdowns? Is that likely?
I don't see that happening. I think that you're seeing, obviously, a large number of people getting vaccinated, and those people who have been vaccinated, they don't want to go in lockdown. They're not going to let that happen. I don't think the states want to see that either. But for me, looking at the news flow, obviously just keep an eye on the 7-day moving average of COVID cases as they pick up here in the U.S. or around the world. I noticed a headline on Bloomberg this morning. First thing this morning was a leading headline that the U.S. is not prepared for additional variants. And I sort of chuckled a little bit, and that kind of gave me, they went back to the well again and trying to lead off with another Delta variant scare. And I'm thinking it's just gonna be another risk on day. It's enough already, at least for the near term.
Okay, let's talk about your trades. But before we do that, actually, let's talk about your economic outlook some more. Last time I had you on early in June, I think it was a couple of days before the non-farm payrolls report came out, and I asked you what your projection was, or your estimate, and you were pretty much spot on. You said the economy would add about 500,000 jobs, and sure enough, they added 559,000. So you're pretty much spot on there.
I think any number, any analyst talking about a number, look at what happened last month. It was way off. I think it's definitely suppressed my expectations. I'm looking for something probably around 500,000.
The economic recovery is happening, pretty quickly. Consumer sentiment is still rather high, despite the COVID fears. Well, the consumer sentiment index is a bit lagged, so we'll see what happens next month. What do you think is going to happen to the GDP growth? We were talking about this offline. The Conference Board is projecting 9% growth in the next quarter. That's a really big number for the United States. Understandable, considering that last year around this time we had a 30% contraction. So we're starting from a very low base level. What do you think is going to happen? Do you agree with the consensus forecast?
Yeah, we get Q2 GDP next week, official first look, and it estimates around 7.5% to 8%. Yeah, you said the Conference Board looking for something at 9%. It's lukewarm, I guess you could say, compared to what earlier expectations were. I'm okay with that here. I think we're going to start to see a lot of that pick up in the second half of the year. I think we're going to see bigger growth, and that's part of what the market was pricing in, ultimately through the last couple of weeks. It wasn't just the Delta variant. It was the fact that the bonds bonds just rallied on the back half of the Fed being, ultimately a little hawkish, talking about tapering. And if they're going to taper, they're going to slow the growth more. So the bonds are pricing a lower growth environment. I think the bonds, which you got to take you got to take edge from the bonds. I mean, the bonds are the smartest. Bond traders are the smartest guys in the room, is the old saying. But I think they definitely got out ahead of themselves. I think the bonds are going to come in. I'm a seller of bonds, seller of the 10-year treasuries here, meaning I think yields are going to rise. I think we get that growth in the second half of the year. I think these Delta variant fears dissipate. Now, going back to the June jobs report, I was right there, but I wasn't. I'm not always perfect, I guess you could say. And then I looked at the Fed. The Fed did surprise with a little more of a hawkish tone. You saw the metal sell off sharply. You saw a lot of risk assets sell off sharply. Stocks held in pretty well. But part of the reason why I didn't expect them to turn so hawkish was because inflation, we had only begun to see hard data inflation. And now, though, we got June's numbers, and July was a week or two ago, and it's hot. I mean, the inflation is there. So now we have three reads in a row, three hot numbers. Now, I look at three being a trend. July and August have higher base comparisons to last year. So we could see that number come in a little bit, and I do think inflation is going to continue to persist through the second half of the year. So we could see a lot of the trading action we saw, say, March and April happen in, say, September, October, November. And that's where I'm anticipating right now as we get expectations for higher growth again.
Well, one thing you did mention last time was that you think that inflation is going to be transitory. Well, the higher levels of inflation at least will correct themselves. Actually, we've had, since we talked, the inflation numbers have risen to 5.4%, up from 5%. So for now, it doesn't seem to be transitory. Do you think that? Do you still think it's going to correct?
Yeah, no, that's exactly what I'm saying. Is I as a trader, as an economist, I look at adapting to what I'm seeing, and the three numbers that, as increasing as they are, I don't want to stand in the way of that. I think we're going to see inflation continue to rise, although July and August numbers that come out in August and September, they could be a little soft. And that's when you're going to see everybody start to say, oh, inflation is transitory. Now, I've switched. I think inflation is going to persist through the second half of this year. And, that's going to give us an interesting environment because you talk about lower growth, which I do think the growth is going to pick up in the second half of the year. But if we do get lower growth, that in higher inflation, we're talking about stagflation. That's the real fear that's out there that this Delta variant could cause, because although the Delta variant would really bring some deflationary aspects, but I think that we're again, it's a very fickle environment. You have a lot of estimates that are out there, but at the end of the day, I think we're going to see growth pick up in the second half of the year. I think we're going to see persistent inflation, and I think we're going to see the dollar rise a little bit for now, but I think the dollar is going to turn lower in the second half of the year, and we're going to see a lot of the similar trading activity that we saw in March and April again in the second half of the year.
I made a theory last year, and I was wrong. This is something I talked about amongst my friends, and I thought that just because we're going to have lower demand from COVID, from the shutdowns, prices would actually fall. We'd actually see a deflationary environment. In fact, the opposite happened for various reasons. This is an interesting phenomenon. So suppose we do have.
You weren't wrong at all. We definitely saw deflation through into the summer. We were seeing inflation numbers contract on a month-over-month basis. And that right there is why we're seeing the higher inflation numbers in April, May, and June, because those low base numbers. And now when we see July and August that come out, again, these numbers are out in August and September. When we see those numbers are higher base numbers. Inflation started to come back in July and August as the economy reopened. Remember, June 1st was really everybody goes back to work, at least some areas. So that was when the reopening had begun, and then inflation had started back. The demand had came back. So we saw inflation increase. Now we have higher base numbers. So we could see, again, inflation that comes out here in the next couple of months that is not as hot as we have seen in the last 3 months, but it still is on course to continue to pick up for the second half of the year.
Yeah, I would just walk through the case here. Why would we see a stagnating economy when everything seems to be opening up? On the flip case, suppose, Bill, we do go back into a lockdown. Why would that cause inflation? Wouldn't that, like we said previously, wouldn't that make deflation the more likely scenario? What do you think is going to happen?
And that's where we are in this fickle environment. That's where you get really quick risk off, like we saw last week. Delta variant and the headlines, uncertainty in the markets. Markets don't like uncertainty. Are we going into stagflation? Are we going into deflation? Are we going into lockdowns? What's going to happen? And that really just ultimately caused the risk off. But the technicals in the market are very relevant. Obviously, we saw where people wanted to step in on Monday to the close, and then overnight, and the market opens up and just surges higher yesterday. Mm-hmm. It's just a very fickle environment right now, and I think you want to see the data. That's where I look at the three numbers we had: April, May, June. 3 is a trend, and I think the inflation is going to be here until I see numbers that tell me otherwise.
So how do you trade this fickleness as a trader? You mentioned that you had switched your stance on inflation based on the latest data point. Have you switched your trades because of that?
Now, looking back to the Fed in June, they sort of need to be a little more hawkish, and then afterwards, it's a sort of Jekyll and Hyde approach. They finally they switched to become a little more hawkish in the meeting, and then you started hearing a little less hawkish or even dovish conversation again, from Powell. We're not moving, and in the end, they're right again in that sense. I think he's sort of still worried about the pandemic, and then you get the Delta headlines. But I think at the end of the day, the Fed from that meeting started course of the fact that they're going to have to taper these assets, but at the same time, we saw their balance sheet into today increased to a new record high, like $8.2 trillion. So it's, they're saying one thing and we're really seeing another. And now that's ultimately, I'm watching the bonds most closely, bonds in the 10-year. And you saw the big rally, the yields get suppressed coming out of that because if they are going to taper, there's going to be a slower growth environment. And that allowed the tech market, NASDAQ and high multiple techs to rally in through into July. And from here, I think a lot of that is a little frothy right now. I like big cap tech. I think there's some really great stocks out there, and I own a lot of them. Or the right amount, I guess you could say. But I think that value is going to come out here in the second half of the year. I think we're going to see industrials, energies, banks, and they're all going to perform. So I'm positioned well to see that in the second half of the year.
Okay. So, all right, we've talked about specific sectors that you like. Let's do a speed round. Our audience loves it when you play this game with me. So I'm going to name an asset class or an index. Just tell me your target. If you don't have one, just say up or down. And just give me one reason as to why. So S&P 500 by the end of the year?
Higher.
Higher? Okay. All right. Gold?
Higher than here. Higher than
silver?
Higher.
Yeah. Oil?
Higher.
Bond yields?
Higher.
All right, interesting. Dollar?
Lower.
Okay, all right. That was interesting. So I'm getting the sense that you're risk on, except you also like gold and silver. So they're not really hedges for you, and you like energy. That's an interesting dynamic here. So how would I sum up your investment thesis? You're obviously bullish, but you don't think there's going to be a huge need to have a sort of a risk on hedge, even though you're in gold and silver. So I think maybe you think that
I think we'll see yields, 10-year yields around 1.5 to 1.7 to finish out the year. We may make a push to new highs in the year, but I think there's a ceiling at 2%. With that said, as a trader, I have been selling rallies and going short in gold. I went short platinum and went short gold into last week. When there was a big level of resistance in gold, 1830, 1835. Now, I think there's going to be a great buying opportunity in gold. I'd love to see it 1770 and load up again, and we could see some choppiness between 1750 and 1800. But I think silver was flushed out, and it still sort of is. I mean, we're basically on the lows, so it presents a good buying opportunity. It may go as low as $24. I think all of this would be a great buying opportunity. I think the policies that we're going to see in Washington when it comes to energy, I think that crude oil is going to be moving higher. I think OPEC Plus bringing back that production a little more than expected. The timing wasn't great given the Delta variant news, and that's when we had this big air pocket and we saw crude oil go. It's roaring back. It's back above $70 here. I think you got to be long crude. I think, again, those policies that we're going to see I think the demand is going to pick up. I think gasoline demand, which has been tepid, is going to pick up again here, continue to pick up in the second half of the year relative to the seasonals. And I think we're going to see energy make a run to $80, crude oil make a run to $80, maybe $100 next year. So I think overall, we're going to see a lot of this stuff, continue higher. I think the equity market, we're going to be choppy. I think pullbacks are buying opportunities. You see what happened Monday. We may go back there this week. We may go back there next week. I think there are going to be buying opportunities, and you just got to be smart. You got to have cash ready to put to work. I think the S&P at the end of the day is going to be moving somewhere to 4,600, and I think 4,600 could be a year-end target. Starting this year, I called it my rolling 12-month target, but it seems within reach here before the end of the year. 4,380, 4,400 has been a big resistance area as well, and once we chew through there, we'll get the next leg.
All right, excellent. Bill, thank you so much for your update today and your forecast. I look forward to catching up with you next time. Thank you.
Thank you very much for having me.
Thank you for watching Kitco News. Don't forget to follow us on YouTube, subscribe to our channel, and follow me on Twitter, David Lin _TV.